So the recent events in the banking system, how does that set us up, A, for a recession or not, more or less likely, and then the implications about how deep that recession might be if credit is less available?
Yeah. I mean, look, we're a very long-term investor, and we own a lot of bonds, so credit is always something we're focusing on. Look, the Fed has had a real issue, right? Inflation got out of hand. They've raised short-term rates the fastest we've ever seen. We're going to see what they do tomorrow. Is it going to be a quarter? Is it going to be zero? In the long run, I'm not sure that's all that material. But what we do know is the highest point on the curve right now is Fed funds. So the bond market is telling us, has been telling us for a while, the slowdown is coming, right? What's happened with this crisis, you would think bank lending is going to slow. MassMutual actually had some of its best sales days ever in the last week, as people have been looking for a strong place to invest, and MassMutual sells annuity products that are that and life insurance products. Mm-hmm. I would say on the margin, the risk has gotten higher. And clearly that's what the markets have been telling us here as well. That said, look, we just heard a good earnings number from Nike, right? You see kind of green behind us. The real economy is actually hanging in pretty well. Inflation's slowing significantly on the goods side. You heard transport prices have fallen pretty dramatically. In fact, they're back where they were before COVID, if you look at kind of shipping rates. Yeah. Oil prices down. Again, you kind of talked about that. On the other hand, service inflation is up because wages continue to be up. We have a labor shortage. We have a really low unemployment rate. Kind of hard to have a recession when most Americans who want a job have a job. So we're cautiously optimistic we're going to work our way through this. But are the risks higher today than they were 3 weeks ago? For sure.
You just touched on the demand picture a little bit for MassMutual's products. But when it comes to an insurance company such as yours, I mean, you are tied to bonds. So I'm curious what the dramatic increase in yields has meant to business, and just as importantly, what the inversion has meant.
Yeah. Look, one of the things that we look at here and we don't understand is where was the asset liability management, right? We all know banks have short-term deposits. Money flew in. Again, you've done the reporting on this, right? And that money had to go somewhere. It went into very safe securities from a respect of getting paid back, mortgage backs and treasuries. But there is no safe long-duration security when interest rates rise. It's just bond math, right? We've been managing our asset liability match very closely for decades because we saw this movie when Volcker did this back in the late 70s, early 80s. So, what happened with ALM is, I think, one of the things we'll eventually kind of fully figure out here. The question that we're worried about is credit risk coming? Because we really have not had a lot of losses kind of work its way through our system yet. So for us, we manage our surplus very carefully. We've never had the benefit of a government guarantee. For 172 years, we've only had ourselves to rely on to make sure our policyholders are going to be taken care of. So we've always taken a really prudent approach to that. And by the way, it's in the name as a mutual. We're owned by our, millions of customers. You think about it a little differently, maybe than if you're thinking about it in a shorter term kind of way. So I think what happened in ALM is going to be one of the things we're ultimately going to figure out here.
I guess it's not different this time, and you've seen quite a few times at MassMutual. Roger, thanks for being with us.
Really appreciate being here today. Thank you so much.